You wake up, you haven't spent a dollar yet, but somehow you're already poorer, not because you bought something, not because you paid a bill, but because of a system quietly running in the background every second of every day. And the strange part? No one calls it a tax, but it behaves exactly like one. Let's start with something simple. Imagine you have $10,000 sitting in your bank account. You worked for it, saved it, didn't touch it. A year passes. You check your balance again, still $10,000 feels safe, right? Except it isn't, because while your number didn't change, what that money can buy did. Groceries cost more, rent costs more, insurance costs more. Even a cup of coffee costs more. That same $10,000 now buys less than it did a year ago. You didn't spend anything, but your purchasing power shrank anyway. That difference? That's the hidden tax. Most people call it inflation. But that word makes it sound natural, harmless, almost like weather. Prices go up. That's just how things work. But here's the part that rarely gets explained clearly. Inflation isn't just prices rising randomly. It's the result of something very specific, the supply of money increasing faster than the supply of goods and services, more money chasing the same stuff, and when that happens, each unit of money becomes worth less, not in theory. In real life, now here's where it gets uncomfortable, because unlike normal taxes, you never voted for this one. There's no line item on your paycheck, no receipt, no official rate. And yet, it might be one of the largest taxes you'll ever pay. Let's walk through how it actually works, step by step, because once you see it clearly, it's hard to unsee. Money doesn't just appear out of nowhere, at least. That's what we're told, but in modern economies, new money is created all the time, mostly through two channels: commercial banks issuing loans and central banks expanding the money supply. When a bank gives out a loan, it doesn't pull existing money from a vault, it creates new deposits digitally, new money enters the system. Now multiply that across millions of loans, mortgages, business loans, credit lines. That's a constant stream of new money being injected into the economy. Then there's the central bank. When economic growth slows, or markets wobble, or governments need funding, central banks step in, they lower interest rates. They buy assets, they inject liquidity. In simple terms, they make money easier to create, and sometimes they create it directly. Now pause for a second, because this is the key moment most people miss. New money doesn't enter the system evenly. It doesn't magically appear in everyone's bank account at the same time. It enters through very specific channels: banks, governments, large financial institutions. They get access first. They spend it, invest it, allocate it, at yesterday's prices, before the full effect of inflation spreads through the system. By the time that money reaches you, prices have already started adjusting, assets have already moved. And your paycheck? It's still catching up, if it catches up at all. This is where the hidden tax reveals itself, because what's happening isn't just inflation, it's redistribution. From people who hold money to people who receive new money first. Think about it. If prices rise 5% this year and your income doesn't, you effectively lost 5% of your purchasing power, not because you made a bad decision. Not because you spent recklessly, but because the value of your money was diluted, quickly, gradually, almost invisibly. And here's the twist: this tax hits different people in very different ways. If most of your wealth is sitting in cash, you feel it directly. Every year your savings erode. But if your wealth is in assets, stocks, real estate, businesses, inflation can actually help you. Because the same forces pushing prices up also push asset values up. That's why you'll often see a strange pattern. People who already own assets get richer during inflation. People holding cash fall behind. Same system. Opposite outcomes. Now zoom out, because this isn't just about individuals. It affects entire economies, entire countries. Governments carry massive amounts of debt, trillions. And here's the uncomfortable truth. Inflation makes that debt easier to manage. If a government owes a fixed amount and the value on the money declines, the real burden of that debt shrinks. They're effectively paying it back with cheaper money. Imagine borrowing $1, and paying it back years later. When $1,000 buys significantly less, you didn't just repay the loan, you repaid it with diluted value. That's powerful, and for heavily indebted systems, it's incredibly convenient. which raises a difficult question. If inflation quietly reduces debt and shifts value in predictable ways, is it just an accident or is it a feature? Because from a policy perspective, moderate inflation is often seen as a good thing. It encourages spending, discourages hoarding cash, keeps economies moving, but from an individual perspective, it's a slow leak, a constant drain on purchasing power, and the strangest part? Most people feel it, but can't quite explain it. They say things like, everything's getting expensive. My money doesn't go as far anymore. It feels harder to get ahead. They're describing the hidden tax, without ever calling it that. Now let's add one more layer, because this is where things get even more interesting. Inflation isn't always obvious. Sometimes it shows up in strange ways. Not just higher prices, but smaller products, lower quality, fewer features. Companies quietly adjust. A snack gets smaller, a service gets stripped down, a subscription adds tiers. You pay the same, but receive less. It's inflation, in disguise, and then there's asset inflation, which doesn't always show up in everyday purchases, but shows up in things like housing, stocks, education, healthcare. Prices climb far beyond wage growth. And suddenly, what used to feel attainable starts drifting out of reach. This is where the hidden tax becomes more than just math. It becomes psychological because it changes behavior. People take on more risk just to keep up. They invest not because they want to, but because they feel they have to. Saving alone no longer feels safe. Standing still feels like falling behind, and that changes the entire system because now everyone is chasing returns. Trying to outrun a force they didn't create. At this point, you might be wondering, why doesn't this get talked about more clearly? Why isn't it framed as a tax? Part of the answer is perception. Taxes are visible. They're debated, voted on, argued about. Inflation is diffuse. It spreads slowly. It's harder to pin on a single decision, and that makes it easier to accept. But another part is complexity. The system is layered. Banks, central banks, governments, markets. Each piece interacts with the others. No single actor controls everything, but together they produce a very consistent outcome, a gradual erosion of money's value over time. Now here's the irony. The system isn't necessarily broken. In many ways, it's working exactly as designed. It stabilizes economies, absorbs shocks, manages debt, but it does so with a trade-off, one that's easy to ignore until you feel it personally. So what does all of this mean for you? It means that doing nothing isn't neutral. Holding cash long-term has a cost. Earning income without growth has a cost. Even stability has a hidden price. It also means that the game isn't just about earning more. It's about where your money sits, how it moves, whether it's keeping up with or falling behind the system itself, because the hidden tax doesn't hit all at once. It doesn't crash into you. It drips slowly, year after year, and that's what makes it so effective. So the next time you hear inflation, it might be worth translating it differently, not just as rising prices, but as a silent transfer of value, one that happens whether you notice it or not, which leaves one uncomfortable question. If this hidden tax is always running in the background, and most people never fully account for it, then who, exactly, is benefiting the most from a system that quietly makes money worth less over time?